Since we last checked in on the Q3 earnings season with our research director, Shiraz Mian, investors have been digesting a flood of corporate reports. We're going to try to hit some of the high points as far as trends this season is concerned. As we near the end of the reporting period, according to published reports, analysts are upbeat about profit forecasts, but some companies might not be. Shiraz, those published reports I'm seeing say 69% of companies have given negative profit forecasts. Why might that be?
So there are legitimate grounds to be worried about the outlook. The proportion you gave was relatively earlier. It's as more companies have reported, that proportion has come down. It's a mixed bag, Terry, as companies look ahead. Some sectors, industrials, housing, materials, and now as we head into retail, those sectors have been struggling for a while. And then there are others that, if not thriving, have been going through a relatively more stable and favorable operating environment. So it's been a tough earnings backdrop the last few years, and we're seeing more of that in the Q3 results as well.
Also, according to those published reports, the word election came up on earnings calls of S&P 500 firms multiple times leading up to the presidential election day. Might that have something to do with those negative forecasts?
Absolutely. There's always there's a lot of uncertainty in the weeks and months leading up to a presidential election. And all of these elections always provide very contrasting visions for the economy, which has repercussions for these companies. And that's what we saw this time around as well. So companies are always very mindful as they discuss their outlook, particularly next year. Not so much Q4, but next year you will have a new administration in place, and then whatever policy package they have outlined in the campaign will have a bearing. And as we all know, our election options always provide very diverse outcomes either way. So yes, I'm not surprised that these earnings calls refer to that, and the uncertainty factor ahead of an election is ever present in the marketplace.
So from what I'm seeing, of all the S&P companies that have reported in this late stage of this earnings season, a decent majority of them have reported actual earnings above estimates. Would you say that's correct?
That is correct. Yeah, it's the proportion of these companies that are beating estimates is a tad bit on the lower side relative to historical periods, but it's accurate to say that a majority of the companies are beating estimates.
So what does the scorecard say right now?
So including all the results that came out this morning, Terry, we have 460 or 92% of the S&P 500 companies have reported results. Earnings are up 6.8%. Revenues are up 5.3%. 73.7% are beating EPS estimates, and 61.3% are beating revenue estimates. And to the earlier point that you made about majority of the companies beating estimates, there is, as you could see, 73.7% beating EPS, 61.3% beating revenue. Keep in mind, though, that this EPS beat percentage, 73.7% for Q3, compares to 77.8%, which is the average over the preceding 20 quarters, meaning 5 years, for this group of S&P 500. Similarly, the revenue beats percentage is also tracking below what we had seen in the 20-quarter average. So yes, a majority of the companies are beating estimates, but that majority of the companies is tracking a bit below the historical average.
And so, what story does that tell?
So, a couple of things. Number one, we had seen coming into the Q3 earnings season that estimates had really come down. And when estimates come down at an above average pace, a cynical interpretation of that typically in the marketplace is that it's the normal expectations management game on Wall Street. These companies effectively, directly and indirectly, setting the bar too low so that they can readily jump through it. So if they are beating at a proportion that's below historical average, then it means the reason for that above average revision space, negative revision space ahead of the Q3 earnings season was not that cynical explanation, which puts us to the real explanation, which most likely is the uncertainty factor we were discussing at the top of the segment, Terry, and just a more cloudy horizon, which makes it difficult for analysts to be more accurate in their estimates for earnings and revenues.
And what is going on in terms of revenues this period?
So revenues are up 5.3%, and as I noted, earnings are up 6.8%. Revenues, it's not a huge change relative to what we had seen from this same group of companies in the preceding quarter. In the preceding quarter, in Q2, it was 5.4%. In the first quarter, it was 4%. So about in line with the preceding quarter and a modest acceleration from what we had seen in the 4 quarters prior to that. But on the whole, not a whole lot one could that one could get excited about.
Did you see any surprises in the tech sector?
So yes, the big tech players, the Mag 7s, it was a mixed bag. We had some impressive results from Alphabet, the Google parent. Microsoft had good results too. It was a replay of the market's never-ending worries about these companies is ever-rising capital expenditures on their AI infrastructure. So to the extent that management teams came out and spelled out a good game as to how they envision monetizing that huge sum of money, capital spending money, the market liked that. And that's what we saw with Alphabet. With others like Microsoft, not so much, and Meta, not so much. So I can't imagine that Meta and Microsoft are wasting the AI capital spending, but I would say their management teams didn't do as good of a job in explaining how they envision this AI spend to benefit their business. Beyond the Mag 7, results are pretty good. On the whole, companies see either a stable or a positive growth environment, and the growth momentum we had been seeing in the tech sector over the last few quarters appears to be well in place in Q3 as well as in Q4.
All right, next we have the retailers reporting and retail sales data coming out. This is going to be the last picture we get now leading into the holiday shopping season as far as the health of the consumer. What will these earnings reports, do you think, say about the health of the consumer relative to all the current retail sales data?
That's right. So it's there's a couple of things, Terry, that we know already. We have been reading about it in other economic data and in previous earnings seasons that in the aggregate, the consumer spending environment remains stable, not growing gangbuster, but growing at a steady pace. The composition of the spending has generally been pretty steady as well. There has been stress and tension at the lower end of the income distribution. We saw that in the last earnings season, and most likely as these big box retailers, Target, Walmart, and others come out with results next week, I would believe we would see reconfirmation of that. There is some early science theory that suggests that the post-COVID surge in spending on leisure, hospitality, dining, travel, that households and consumers were leaning towards, maybe starting to wane a bit, and it's possible that this is just pre-election jitters in the among consumers, or it could be a sign of something enduring. And if it's enduring, then that would be a good trend point for some of these retailers that have a more discretionary spending type of merchandise, or that has more of a big ticket items on their merchandise. So we know Target, which leans to be more discretionary, has been struggling. Walmart's discretionary merchandise has not been doing as good as their grocery and staples business. So I'm assuming that we'll get more clarity on this, particularly from the Walmart and Target reports.
So as we talk here on November the 14th, what do you think the overall growth is going to look like for Q3? And are we going to be looking at maybe the fifth consecutive quarter of growth year over year?
Oh, absolutely. Absolutely. We have, if we look at the blended growth, the few companies still to come and the majority that have come out, we are showing about 7.5% to 8% earnings growth year over year in Q3. And you're absolutely right. This will be another quarter positive earnings growth. And in fact, it's in the lower double digits, north of 10%. If we look at the growth on an ex-energy basis, energy, as you know, has been a drag on the aggregate growth picture. So yes, Q3 in the final analysis should be another quarter of positive growth. And this gets better as we go into the fourth quarter and then next year.
All right. Want to remind our listeners that they can always check out the latest written commentary by you on the earnings trends right on our homepage at Zacks.com. And those commentaries change twice a week, once on Monday with the earnings preview and once on Thursday with your earnings outlook. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.